Welcome, everyone. This is Denise Solzbach. I'm the Director of the National Center at the Institute for Innovation and Implementation at the University of Maryland School of Social Work. I want to thank you for joining today's Managing Now for a Better Tomorrow conversation. Today's conversation is the second in a four-part series on the business of family-run organizations, and this one's focused on nonprofit retirement plans. For those of you who are tweeting, please join us. Please use the hashtags BetterTomorrow and TA Network Talks, and please tag us at Institute UMSSW. We recognize that this is a challenging time for all of us and do appreciate you taking the time out of your days to take the time to join us today. Together, we can make lasting solutions to address social justice and race equity in order to build a better tomorrow for all children, youth, young adults, and their families. We have developed these conversations to create peer-to-peer opportunities for you to talk with presenters as well as one another. We encourage you to use the chat box to share your thoughts and resources as well as questions for our presenters. When you use the chat box, please select all participants. This will allow everyone to see what you are sharing. In follow-up to today's conversation, everyone who registered will receive a link to today's recording as well as resources and highlights shared in the chat box. As I mentioned, this has been a conversation series. For those of you who are interested in prior recordings, we have recordings on crisis communications and in-home, as well as in-home behavioral health supports, supporting families. Our host for today's webinar, Fredla, did 2 on supporting families in this series, as well as residential interventions, rural health, infant and early childhood mental health, mobile response and stabilization, supporting students and families, both from the perspective of students and their caregivers, as well as schools and educators. We also have one on housing and homelessness, and our newest one that we held earlier this week, adapting to the new ways of practice for LGBTQ+ youth. And we also have a recording for the first one in this business series on budgeting and cash flow. To find these recordings, as well as additional COVID and race equity resources, please visit the institute.umaryland.edu/COVID-19. And with that, I'm going to turn it over to Jane Walker, who's our host for today. Jane, you may be muted.
Jane? Yeah. Sorry. I apologize, everybody. I was on a roll and didn't realize no one could hear me. So I'm going to start over. Welcome to Fredla's webinar series titled The Business of Family-Run Organizations. We welcome all of the executive directors, office managers, program directors, and perhaps board members who may have joined us today. Please introduce yourself if you choose in the chat box, and ask any questions that you may have during the course of the webinar. This is the second series of 4 webinars over on the topics focused on business operations of family-run organizations. As family-run organizations, we must operate as businesses. Often the passion for our work takes precedence over the business operations. So for that reason, Fredla is offering this series of webinars focusing on topics related to running a small business. My name is Jane Walker. I'm Senior Advisor at Fredla, and we are a partner in the National Technical Assistance Network operated by and coordinated through the University of Maryland. We are grateful to the TA Network for hosting this webinar and to Cahill Bishop and Sarah Warner, who are part of the tech team at the university that works the magic to get all of us connected. So here you have team members. And in the event you may not be familiar with FREDLA or with these calls, FREDLA is a network of family-run organizations all started by families who are caring for a child or young adult with mental health or behavioral health needs. FREDLA's mission is to build leadership and organizational capacity of family-run organizations, promote their value, and influence policy for our children and families. State and national organizations and offers technical assistance to family-run organizations, states, and other stakeholders. As family-run organizations, the majority of our employees are motivated by their personal experience of caring for a child with mental health needs. In surveys FREDLA has conducted, we've seen that employees of family-run organizations tend to stay, and there's little staff turnover. It's not unusual for employees to work 15, 20, or more years for a family-run organization. Run organizations, like many nonprofits, back on employee benefits to make ends meet. Employees can leave an organization after 20 years with nothing more than a sense of satisfaction, lifelong friendships, and cherished memories. However valuable these are, they do not help to pay the bills in retirement. For this reason, FREDLA felt it was important to provide information on cost-effective retirement plans for family-run organizations. We are pleased to have with us Amir Eyal inform us about options available to nonprofits. Now, I met Amir at a moment that nonprofits never want to find themselves in. I was with a nonprofit organization that thought we had a retirement plan, only to find out in a discussion with Amir that indeed we did not have a legal retirement plan. Almost a year, and I might add many sleepless nights, to unravel the situation, but throughout, Amir was most helpful. Amir leads Mylestone Financial Services as the group's managing principal and CEO, while also serving clients as a financial planner. He also acts as the employee and executive benefits specialist for the Center for Nonprofit Advancement. The center is a leading advocate and service provider supporting nonprofit organizations in the greater Washington, D.C. area and the Commonwealth of Virginia. There is a licensed attorney, a registered representative, advisor representative, a certified financial planner, and an accredited investment fiduciary and licensed health agent. That's to say, he knows his stuff. So it is indeed my pleasure today to introduce Amir Eyal. Please.
Jane, thank you so much for the very kind presentation and introduction. Can everyone hear me? I hope so. Oftentimes with these informal WebExes, you never know if you're talking to yourself. Yes. Okay. Thank you, Jane. All right. So thank you, everyone, for attending this presentation about cost-effective retirement plan solutions. Thank you again to Jane and FREDLA for giving me the chance to go over what I think will be a very productive presentation. I don't have control over the PowerPoint, so I'm just going to say next, and hopefully someone will press a button to go to the next slide. So if we could hit next, please.
Amir, this is Jane. I'll run the slides for you. Is this where you want to be?
Yeah, perfect. So next one, please. So the following one, the next one.
Amir, right now you're the only one who has the ability to advance the slides.
Oh, okay, perfect.
You use the arrow buttons on the left-hand side. They're below and above the number 7. If you can see that.
Yeah, perfect. Perfect. Okay, great. Okay, thank you, everyone. So a little bit about Mylestone, my firm and myself. Like Jane said, in my former life, I was an estate planning attorney. I'm a certified financial planner, and Mylestone has been around for over 30 years, of which 16 of those years I've been the CEO of the firm. We principally work with nonprofit organizations. We work with over 500 of them. We specialize in group benefits, in investment management. We work individually with private clients, executives, and employees of nonprofit organizations. We've been endorsed by several membership organizations like the Center for Nonprofit Advancement. We've been publicized in several publications, the HuffPost, Forbes. And the most important thing that we stick to when we engage our clients and give advice is that we follow the fiduciary best interest standard, which is very simple. We put your best interest ahead of ours. This was something that was drilled into me when I was an attorney. It's something that I'm glad has been enforced and regulated in the direction that our industry is going. And every individual that engages a financial advisor should get that treatment, because there's just so much information out there, and you never know, what is really in your best interest. So let's see. Okay, so what I wanted to cover with everyone today is there's really 2 components in structuring a retirement plan. There is the design of the plan itself. There's that component, which affects cost. And then there's after you design the plan, that should take you into the category of products. So what product do I choose to carry forward the design of the plan? And depending on the product that you choose, the cost will obviously be different with each product. So, but before I begin, there are many ways for a family-run organization or a micro nonprofit or even a small business to set up a retirement plan. There are really 4 main retirement plan programs right now. I will focus on one of them, which is the 403B and the 401K retirement plan program. But keep in mind that there's also a SEP IRA option. I don't see a lot of these, but it is something usually that sole practitioners set up. But a SEP IRA, Simplified Employee Pension Plan IRA, you are able to fund your employees' retirement accounts with employer money. So they cannot save from their own salary. You, as the employer, would give an employer contribution, let's say a flat % on a discretionary basis to everyone. And that could be a retirement plan. The next type of retirement plan is a simple IRA. This is a very simple retirement plan, really, just like the name. You can't really design it in many different ways to benefit your organization. It follows a very strict rule. And the rule is, as an employee, you're able to save up to $13,500 of your paycheck as a participant. If you're age 50 or older, you can contribute $16,500 through the catch-up. And also, if you're going to be providing a simple IRA plan to your employees, there is a mandatory employer contribution. So you have to give some sort of free money to your employees, and it comes in two forms: a 2% flat employer contribution to everyone based on their gross salary, or a 3% match where they will get the employer money if they put in a percentage of their gross salary. So if they put in 1%, you have to give them 1%, 2%, you have to give them 2%, and it caps at 3%. So if they put 10% of their salary in there, you still have to give them 3%. A simple IRA has a mandatory employer contribution, so you have to give people that money once they're eligible. I'm not going to go into the details of these two because I want to focus on the 403B and the 401k world and a little bit about an executive deferred comp plan. But please keep in mind that anyone watching this presentation, you're going to have my contact information at the end of this presentation. And if any of you have any questions, please feel free to call me or email me, and I can address any of your questions at that point in time. All right, so we're going to talk about 403Bs and 457s. We're going to talk about plan design, and then we're going to move on to product selection. Okay, now, obviously, before I begin, why is a retirement plan important? Very simple. Eventually, everyone is going to stop working. And once you stop working, there's not going to be a paycheck coming into your checking account every 2 weeks or every month automatically. You're going to have to depend on whatever resources you have, whether it's Social Security or your savings. And I think this quote by Nelson Mandela summarizes everything very well. We really try to empower people to take control of their future. And the more people we reach out to and the more people we talk to and educate, I think the more impactful we are in achieving our goal of empowering everyone to achieve retirement. Okay, so let's talk about plan design, 403Bs and 401Ks. Oftentimes we get the question about what's the difference between a 403B or a 401K. Well, nonprofit organizations, specifically 501c3 organizations, can have both. They can have a 403B or a 401K. All other 501c organizations, C6s, C4s, et cetera, they can only have a 401K. What are the differences? There really isn't any difference other than a few different discrimination testing items between a 403B and a 401K. And 401Ks can hold individual stocks. And 403Bs, we don't see them holding individual stocks. But for all intents and purposes, they operate the exact same way. Everyone can shelter up to a certain amount of money per year, up to $19,500 if you're under 50 years old, or $26,000 if you're age 50 or older. You can design the plan with an employer match, with a vesting schedule, and so on and so forth. Now, the difference between a 403B and a 401K in terms of how they're subjected to the Employee Retirement Income Securities Act, ERISA, is different. So all 401K plans are subject to ERISA rules. And simply put, ERISA rules means that there's a higher level of fiduciary responsibility that the plan sponsor, the person who is responsible for the retirement plan, has to
Amir, you're kind of coming in and out.
Oh, no, that's not good. Thank you for letting me know. Is that better?
There?
I'm there. Is that better? Is that better, everyone?
Yes, we can hear you.
I think we might have lost his audio.
No. Can you hear me now?
Yes, I can hear you.
Okay. So some people can hear me, other people can't?
I can hear you clearly.
Okay. All right. I'm going to continue. So in the 403Bs, if you do not offer an employer contribution, then you are not subject to ERISA rules, and that will make the plan less expensive, and you won't have as much work as a plan sponsor from a fiduciary aspect if you don't have an employer contribution in a 403B. Now, if as soon as you start offering an employer contribution like a match, then you're subject to ERISA rules. So sometimes when we set up retirement plans for organizations that are not yet ready to give an employer contribution, we normally set them up as a non-ERISA plan, and it saves them money. And then in the future, when they want to make an employer contribution, we might convert the plan to an ERISA plan. Another thing with respect to plan design that everyone should be aware of is that if you have any employees that earn over $130,000 a year, usually the executives, then they are considered highly compensated employees, and therefore both a 403B and a 401K, they would be subject, and the plan would be subject to discrimination testing, which can cost more and make the plan a little bit more complicated from a design standpoint. So oftentimes when we engage organizations, we ask them what type of organization are they, and then if they have any highly compensated employees, and if they want to make an employer contribution. A question about what is discrimination testing. Discrimination testing is something that the IRS has, or the Department of Labor has put in place to make sure that organizations don't take advantage of the 401K or 403B benefits. What happened in the past was that companies were setting up 401Ks. The owners of the plan were just giving themselves as much employer money as they can shove into the plans. Remember, there are huge tax benefits when participating in these retirement plans. And those owners were not even telling their employees that there was a retirement plan and that there was a benefit, because remember, anytime they have to give them employer money, it costs the employer something. So the powers that be caught wind of this, and they implemented a rule which forces organizations to conduct discrimination testing to make sure that the highly compensated employees, in 2020, it means those who are making over $130,000 a year, don't overly benefit from those that are non-highly compensated employees, those employees that make under $130,000. So there's certain rules about how much people that are non-highlies have to put in order for the highly compensated employees to be able to receive a certain amount of employer contribution. And if you're interested, Millie, I can send you a little bit more from an excerpt from my book about discrimination testing.
Amir,
Good
this
question.
is
Yeah.
So to be clear, the 403B plans could be set up at virtually no cost to a family-run organization. In other words, if they have no employer contribution, but the employee can make their own contribution, other than some administrative work, it would not be any outlay of money. They would not have to budget any money for that 403B. Is that correct?
That's absolutely correct. So if you're very familiar with the product sphere, because there are different vendors out there, if you're very familiar with what products are out there, you can create a plan that is low cost administratively. I mean, nothing is, totally free, but it could be very inexpensive. And if you think about it, and as we're going to see in the next couple of slides, The biggest expense in running a retirement plan is the employer contribution that you offer to your
Right.
staff. Right? So yes, so you're absolutely right.
If an organization couldn't afford to make a contribution, they could still set up the retirement plan.
Absolutely.
Yep. Okay.
In fact, one way that organizations can set up a plan, if they do want to give an employer contribution, but they're not sure about how much or what their budget is going to look like, because really to get people excited and putting away money for retirement, if you give an employer contribution, you're going to increase the probability that people will save for retirement, especially if you set it up as a match where they have to participate to get something. Employer contributions in 403B plans and 401K plans can be designed as discretionary contributions. Oftentimes in designing a plan, we simply state that any retirement plan contribution, whether it's a match or it's a lump sum non-matching contribution, because you can give everyone, a percent without them having to put any of their own money in. It could be designed as discretionary, so that if the organization runs into budgetary or financial issues, and believe me, we've been having a lot of conversations with organizations after and during the COVID crisis, they can reduce their employer contribution and even eliminate their employer contribution because they stipulated it as a discretionary one. Employer contribution can be designed as a match or a non-match. So I touched a little bit upon that. A non-matching contribution would be something like, my organization is going to give 5% to everyone, so long as they're, 18 years old and work, full time, right? So nobody has to really put any of their own money for the organization to give that type of non-matching employer contribution. That is the more generous way to reward employees. A match requires you to put in, requires the participant to put in money to get anything. That is something that really encourages participation. But again, it depends on a lot of different factors and what you can afford and what you philosophically believe in. So let's say we're planning for an employer contribution. If you think about it, you can just run some basic math. A 1% employer contribution equals $1,000 a year that you should budget for per 100,000 of gross payroll. All right. So if you have a payroll of 500,000 for your organization and you want to give 1% to the staff, then you should budget $5,000 a year for it. All right. So that's where the biggest expense is in running a retirement plan. So in my other example, I have $1 million gross payroll. We want to give 5% employer contribution. Therefore, our total potential obligation, assuming 100% participation, is $50,000 a year. Now, you can structure that 5% as a lump sum, non-matching, and then you're obligated to give $50,000, or a matching, and you could have 100% participation. You might have 75% participation. It all depends on the engagement of the participants. But I would always budget for the highest amount, just in case you have 100% participation rate.
Amir, I've known nonprofit boards that defer, as you say, they set it up as discretionary, and they defer to the end of their fiscal year to make a determination and then kind of make one lump, not one lump sum, but one designation. This year we can afford 1%, or maybe it's been a good year, they could afford 2%, or maybe it's not been a good year and they don't have any match. Is that something you see a lot of?
I do. You could absolutely do that. You can actually defer until the following calendar year. You have time. And yes, sometimes we see organizations making that determination later down the road. Other organizations like, if you think about it, if you're a participant, you would prefer that the employer contribution be deposited every pay period and buying the market at different points in time rather than a big lump sum buying it at one time a year. But you can design your plan with a lot of flexibility to protect your organization. Yes.
Great.
Point.
Thank you.
Okay. So there are a bunch of different mechanisms to reduce cash flow obligations to make the plan more something that the organization can take on if funds are very tight. Like we mentioned, we can make employer contributions discretionary, so you can turn them off and then increase them on later down the road. You can also add an eligibility waiting period before someone is allowed to receive the employer contribution. In the 403B world, everyone must be allowed to save their own money from day one of being hired. In the 401K world, you can restrict employee contribution for a future date to allow them to enter the plan up to 2 years. Employer contributions, however, can be in the 403B world can have an eligibility waiting period added to them. As remember, there's a distinction. As a participant, you can save your own salary. Those are employee contributions, salary reduction. And then there's the employer contribution, which is what I'm talking about right now. So you can add an eligibility waiting period for up to 2 years before someone can receive employer contributions. If you pick 2 years, though, so if you make someone wait 2 years before they can start getting the employer contribution, then you have to make the employer contribution 100% vested. In other words, they have to own all of that employer contribution from day one. And we'll talk about vesting very soon. Oftentimes what we see with nonprofit organizations is some sort of eligibility waiting period because they don't want to give employer contributions to a new hire only to have that new hire leave in 3 or 6 months and take that free money with them. So we usually see a 6 months or a 1 year eligibility waiting period. Think of it as a probationary period before someone is, welcome to the group to receive employer contribution. Another mechanism to reduce cash flow obligations when you're designing a plan is to add a vesting schedule. Vesting simply means ownership. And what we're talking about here is that once an employee gets an employer contribution, they don't own it all from day one. They have to work for the organization for a certain amount of time, certain amount of years, before they own that employer contribution or a portion of it. So what I show here in the slide is that I show a 4-year vesting period where each year you own 25% of the employer contribution that you receive. So let's say I start working for the organization on January 1 of 2020, and then I leave after 3 years. Well, whatever employer contribution I got, I would get to keep 75% of it. And the other 25% goes back to the organization, to my employer, and they can take that money and give it to the other employees or just save it for future use. We don't see too many vesting schedules in nonprofit organizations simply because they recognize that salaries are lower at nonprofit organizations and they want to reward people more. But we do see eligibility waiting periods to counteract the fear of people leaving and taking money. The last way you can reduce cash flow obligations to protect the organization is adding a last day rule to the plan. Essentially what you're doing here on the last day rule is an employee has to work for you until the last day of the plan year, and let's say it's calendar year that we set up the plan for, so December 31. If they don't work past December 31, then they don't receive the employer contribution for that year. Now, this is the harshest of measures to prevent an employee from getting an employer contribution. And we don't have too many organizations that utilize this. But again, it's a tool in your belt that if you're trying to protect the organization, it's something that you can add to your plan. Any questions about any of this?
Amir, it's Jane again. So it is important that with the 403B, upon hire, an organization with a 403B plan, and I'm not sure about the 401K, but would open or ask their employee if they would like to, at that point in time, upon hire, open up an account and make their own contribution from day one. Is that correct? Then the employer contribution could be established after an eligibility criteria is met of 6 months, 1 year, something like that. But upon hire, if your organization has a plan, the employee must be allowed to open it on day one. Is that correct?
That's 100% correct. So that's the universal availability rule applies to 403B plans. Mm-hmm. And so one of the important things, that's a big thing in the 403B world. All employers have to give their employees the ability to save their own money on day one in a 403B. Again, remember, it doesn't cost the organization anything. It's their employees' money. For the 401K world, you can tell an employee that not only will your employer contributions start not only do you have an eligibility waiting period of 1 year or 6 months for your employer contribution, but also your own contributions, you're going to wait until putting those in. You're not eligible to even begin participating in the plan until your eligibility waiting period for employee and employer contributions are done. A question from Melissa. If they do not open an account immediately, can they open an account on a later date? Absolutely. Now, it's the employer's responsibility to let the employee know that they have a retirement plan and that they can enroll on day one. But if they don't, there's no problem. They can do it later down the road. Unfortunately, what we see is many organizations, the HR, the CFOs, the executive directors, they do a good job. They tell their participants that there's an employer contribution and there's a match. They even have an advisor come in and give a presentation and educate the staff. But people don't start participating until many years down the road. Sometimes missing out on receiving an employer contribution because it was based off a match. But what's important for you as an employer is to know that if you have a 403B, you have to tell your employees on day one. What they choose to do with it is ultimately their responsibility.
Many of our organizations have young employees, and my experience has been very difficult to get them to sign up for a quote retirement plan at 20 years or older, something like that, and I think that's a challenge for executive directors or HR people in organizations is to try to encourage their younger employees to sign up. Often the older ones, they want it. They're jumping on it, but the younger ones often don't feel it's relevant to them when it could be extremely helpful.
I agree. And some of the things that organizations have done to combat this is instituting an automatic enrollment procedure, forcing new employees to opt out of enrollment, so they have to fill out a form. They can do that. The other thing is some organizations even have a mandatory contribution. So if they're going to work for you, you have to contribute a certain amount. You can't even opt out. It's a mandatory contribution. It's usually tied together with an employer match or something like that. But automatic enrollment has become a very popular, automatic enrollment and auto escalation to allow those, the contribution to grow over time automatically without having to do anything so that employees save more is becoming very, very popular. Do a lot of organizations do the automatic enrollment? We've seen more and more, Millie. Again, it depends on philosophy. Larger organizations do, simply because administratively it's easier for them to run the plan. So if we're working with private schools, public charter schools, we see a lot of that happening in larger nonprofits. For smaller nonprofits, not so much because they want to give flexibility. I think what I would recommend for smaller organizations, it's like you're reading my mind, Millie. It's amazing. I would recommend that they have a really good relationship with an advisor that comes and educates their participants. So it takes care of two things. It takes care of their education because they need it, and it takes care of your fiduciary responsibility of making sure that, you know, everyone knows what's going on with the plan. It's front and center, and in that way, especially if the advisor does a lot of one-on-one meetings where they sit with each participant, helps them choose the investments, talks about their goals, then that should be sufficient. Okay.
Great.
Okay, so safe harbor. Some organizations may have highly compensated employees, as we mentioned before, those earning over $130,000. If you have an organization where the executive earns over $130,000 a year, and you're going to have to run a discrimination test, and you want to give an employer contribution, that's the only time you have to run a discrimination test. There are a couple of techniques to get rid of that discrimination test to reduce cost and complexity for the organization. The first way to do it is to remove the highly compensated employee, usually the executive, out of the plan and say that the executive is not going to be receiving any employer contributions. So now you don't have any highly compensated employees, and you have to worry about discrimination testing. Obviously, the executive will, unless they're extremely charitable, they will want to receive the employer contribution somehow. And what we've done for people is that we've set up a deferred compensation plan through a 457B for that executive separately, and that takes care of the discrimination testing issue. 457Bs are also great just to allow an executive director to save more money and receive an employer contribution from the board on a negotiated manner, purely on a discretionary basis by the board and the executive. Alternatively, if removing the executive director or the CFO or whatever, the highly compensated employee from the plan isn't a possibility, you can design the plan as a safe harbor plan. Simply, the term safe harbor means that the IRS, if you follow the following two formulas, then the IRS deems your plan to be within safe harbor, and you're doing whatever you need to satisfy them not being upset with you that you're discriminating. The two formulas are the following. You give everybody 3% and make everyone 100% vested. They own it all. You can have an eligibility waiting period. You can make them wait a year or 6 months or what have you, 2 years. But you have to give everyone 3%, no matter if they put in their own money or if they don't put in their own money. You can enhance that 3%. If you want to give more, the IRS isn't going to say that's not part of the formula. You're just being more generous. Second way is by a match that follows the following formula. It's 100% match on the first 3% of their contribution, and then 50% match on the next 2% of their contribution. The way the math works out is if I put in 5, you're going to give me 4. And here's a little table that shows what happens. If I give 1, I get 1. If I put away 2% of my salary, my employer gives me 2. If I put 3, I get 3. If I put 4, I get 3.5. If I put 5, I get my full 4. Anything above 5%, I still only get 4. You follow those two formulas, then you don't have to conduct any discrimination testing. Any questions about this? Okay. Well, one thing to know is that the employer contributions in the safe harbor match or any safe harbor contribution, that's a mandatory contribution. It's not discretionary. So another way to just get around the discrimination testing, is to give everyone a lump sum and stick to a fixed percent. And then by definition, in a 403B, this only works in a 403B, by definition, you can't discriminate because everybody's getting a 3% or a 4% employer contribution. Once you start designing a plan with tiers, like sometimes we see organizations design the plan with people who have worked for their organization for under 5 years get 3%, from 5 to 10 years they get 5%, from 10 to 15 years they get 6%. Now you're starting to be all over the place and there's more potential for discrimination testing failure. Again, if all this is very confusing, this is something that I can talk to you about separately, individually, especially if you're thinking about designing a plan. You're more than welcome to give me a call, bend my ear, and we can, design a plan that works for you and will protect your organization and provide your employees, the ability to save for retirement and accomplish their goals. Any questions about this right here? Okay.
A lot of family-run organizations wishing they had a highly compensated employee.
Right. It's only relevant when it's relevant. Right.
Right. I think a lot of them are earning significantly less than that.
Okay. So once you've designed the plan, and we just talked about different ways to design the plan. And remember, the majority of the cost will be based on the employer contribution you want to give. Once you've designed the plan the way you want, with good direction from someone that's working with you, the next thing you need to do is choose a product, right? Because you're creating the rules of the plan, and now you need some sort of product to carry forth those rules. Okay, so right here in this image, what you see in front of you are the different parties to a retirement plan transaction, whether it's a 401k or a 403b. At the top, we have you. We have you as the plan sponsor. You're the fiduciary. You're responsible for the plan. Now, if you wanted to, you could do everything yourself. You can run the plan on yourself, record keep, administer it, etc. Normally what we see happen is that plan sponsors hire help to make sure that they're doing everything properly because it's not their expertise. Remember, a 401k or a 403b plan is not like an IRA or a brokerage account that you set up at in an institution. There's real fiduciary liability when running a plan. If you don't do something right, if you don't send contributions on time, if you don't record keep properly, if you don't do discrimination testing, and you run a plan for many years, and a lot of participants rely on you, and you get audited or something happens, and everything in the plan becomes taxable to everybody, and there are penalties and so on and so forth. So it's always best to work with professionals that do this all the time. So what happens? The plan sponsor hires an administrator, a custodian, to hold the money, and a record keeper. And you can see a little dollar sign is this plan sponsor and sending money to the custodian. So the record keeper, usually the record keeper and the custodian, they work together. They're the same entity. The record keeper deals with the accounting components of the plan. They make sure the money goes into the right investments. They make sure the money goes in on time, that everything gets reported properly. They're the ones that send the quarterly statements. They provide the web access so people can go online and review their accounts. So they're very important. And then there's the administrator, and the administrator deals with the legal components of the plan, like the plan documents, the testing, the processing of distributions, amendments, everything you need to run the plan legally. Sometimes the administrator, the custodian, and the record keeper are all the same company. It's bundled. Sometimes it's not bundled. Sometimes the administrator is a third-party administrator. You may have heard of that term. Sometimes the record keeper is different than the custodian. What we like to do is we like to keep everything together to make your life more simple. So we like to work with vendors that bundle everything together. The last party to the transaction is the financial advisor, who's licensed, who acts as a co-fiduciary with you to help you in your duties as a plan sponsor. They keep the other parties in the transaction honest, and of course the financial advisor is there to help you with the investment policy statement for the investments, choosing the investments, education, enrollment, and everything else. So once you understand the parties to the transaction, you understand that the administrator, the custodian, the record keeper, and the financial advisor all have to get paid somehow. So you really have to find the right products to fit your plan design. So I did one quick comparison for you between two vendors. For either a 403B or a 401K, the cost is the same. There's no difference in cost, really, unless, again, it's dependent on plan design. But if we were to compare a Lincoln 403B and a Vanguard 403B as an example, and we use these Lincoln 403Bs for small micro nonprofits, the record keeping and administration cost, remember, record keeping, administration, right? Just follow this image in your head. It costs $0. So to the point that Jane was making before about a non-ERISA versus an ERISA plan, Lincoln will charge nothing to set up, or no annual cost to set up the non-ERISA plan. They will charge a $500 one-time plan document setup fee for a non-ERISA plan document. Those didn't exist in the past until a number of years ago, where the DOL or the IRS forced it upon everyone. But it would be a startup cost of $500. If you wanted an employer contribution, so now if you have an employer contribution, you are now an ERISA plan. Again, ERISA stands for the Employee Retirement Income Securities Act. So for an ERISA plan with an employer contribution, there is a $450 annual 5,500 IRS filing that Lincoln charges. So $500 one time for the plan document and $450 a year for the 5,500. Pretty inexpensive. Now, if you design a plan with the match and you have highly compensated employees, and you don't do safe harbor, then there's an additional $500 a year for discrimination testing. But most plans we're able to design without the need to pay for this $500. In this plan, so now let's compare the record keeping and the administration to Vanguard 403B. At Vanguard, there's a $1,500 one-time setup fee. And Vanguard, there is no differentiation between non-ERISA or ERISA in this respect. This is their cost, whether you set up a non-ERISA or an ERISA plan, whether you have employer contributions or not. So you see, you really need to know what products are out there to make an informed decision. So $1,500 one-time fee. And then if you have 1 to 15 participants, it'll cost you $3,840 a year to administer the plan. Any participant over 15, it'll cost $70 per year. Now, obviously, this is more expensive than the Lincoln 403B, right? So what's the catch? Well, going down to the next row, there's the advisor compensation. With a Lincoln 403B, there is no additional cost for the advisor compensation. It's built into the program, and Lincoln pays an advisor a percent based on the contributions made to the plan. At Vanguard, this is a fee-based retirement plan, a fee-based 403B or 401k plan, where the advisor adds a percent of the assets management fee, right? So in this case, a very, very normal fee for an advisor to charge on a plan is 0.5% a year on the assets. Okay, so right now we see the Lincoln is still less expensive than the Vanguard. Okay, going down to the next row, we have the fund expenses. So here's the part that's interesting. Now, the investments that the participants choose in their retirement accounts will have a fee, will have an expense. At Lincoln, the average fund expense is 1.5%. The average fund expense at Vanguard is 0.15%. In fact, in Vanguard, you can structure the plan in any way. You can make it even less expensive because you can choose any mutual fund or index fund out there in the industry, whereas Lincoln has a closed 50 investment platform. So you can only choose from 50 investments that they have chosen. So, you know, if you think about it from a participant standpoint, if your employer is going to pay all of the fees, the Vanguard plan is a lot more beneficial to you as a participant, right? Because it's less costly. It's very difficult, though, for a lot of small nonprofits to pay this fee. And a lot of small nonprofits don't have $1 million, $2 million, $3 million in their plan for them to go to Vanguard and say, you know what, Vanguard, take this $3,840 and just embed that cost as a percent against the assets in the plan. So a lot of organizations, especially the executives, they wear two hats. Not only are they the participant that want a very low-cost plan as a participant, but they also have to be mindful of the cost of the organization. And when they're looking at $450 a year versus close to $4,000 a year, they say to themselves, you know what? That additional $3,400 could be used for an employer match. And that's going to be a lot more impactful than, you know, getting a reduced cost on the investments. So as you can see, there are a lot of different things you need to think about when designing a plan. And what we do is we work with you to figure out, you know, your budget and what makes sense. And, you know, if you could do the Vanguard plan, and there are other vendors out there. I'm just picking on these two because these are very popular. If you could do the Vanguard plan, pay the $4,000, give the people in your organization a nice employer contribution, obviously this is the one you want to go with. If you're trying to start out and get something going on in your organization to let people save, the Lincoln plan is a very nice startup plan, and eventually you can convert the Lincoln plan to a Vanguard plan once the assets grow.
So, Amir, this is, I think it's complex, and an ideal area where board members could be very helpful to executive directors in meeting with different advisors about setting up plans, comparing plans, and things like that. I think that would be really helpful because there's, as you can see from this chart, a lot of details, and it's not comparing apples to apples. It can be very, very confusing. If you go back to the previous slide with the diagram.
Sure.
Just to clarify, the custodian would be the equivalent of a Vanguard or a Lincoln, correct?
Correct. In the two examples I gave you in the slide after this one.
Right, or
Lincoln,
others. We're not promoting any one plan or product here, but that would be the custodian. The family organization would be the plan sponsor.
Correct.
And could be also, if it's a small organization, like the administrator as well.
No.
Right?
So Vanguard would be the administrator, the custodian, and the record keeper.
Oh, okay.
You definitely do not want to be the administrator on the plan.
Okay.
You don't want to have anything to do with the plan documents and anything like that. You want, in this case, both Lincoln and Vanguard, those two plans are bundled. So they act as the administrator, custodian, and record keeper.
Okay. So having set up these plans in about 4 different organizations, it's key that you get somebody that you can work with on doing that. There's a lot of nitty-gritty things like, what is your plan year? Does it coincide with your fiscal year? Do you want it a calendar year? And there's pluses and minuses to both of those. The whole eligibility criteria, the whole thing of when somebody leaves, what can they take with them, the whole, so it's not difficult, it's complex to think through. And so having somebody that you can talk it through with, a board member or a board member with you, working with someone, an agent from, say, Lincoln or Vanguard or somebody else. And then filing that 5,500 is critical, and paying that is a budget item that is essential. Paying the filing, somebody to file that 5,500, because if you, Amir mentioned, you can get in serious trouble with the IRS. Take it from somebody who knows. That was what happened to us. We had not filed the 5,500 for a couple of years and had to pay a penalty to the IRS, which is probably the last thing anybody wants to do these days. So, so working with somebody on your board, somebody, an agent from some financial advisor, whatever, is the key to working through all this. Okay, thanks, Amir. I just wanted to clarify this diagram here. Okay?
Sure, absolutely.
Okay.
And just know that, you know, if you're working with Vanguard or Lincoln or One America or Nation or whatever it is, they will be the ones preparing your 5,500. They will set everything up for you to press a button and file it.
Yeah.
And that's really what you're paying them here for under the record keeping and administration.
Right.
With respect to the advisor, work with an advisor that is a broker of many different vendors, that is not beholden to one company.
That's a good point.
Because it's going to be a lot harder for you to go to Vanguard, to go to One America, to go to Lincoln. Honestly, most of the time they're just going to say, where's your advisor? Go find an advisor. Mm-hmm. Work with an advisor who's a broker. Don't work with a captive agent. Again, work with a fiduciary simply because their mandate is to operate within that sphere. So, for example, my firm, we would go and broker out for you all the different, well, within reason, a lot of vendors that fit the plan design, step number one, that we have experience using that will be a good fit for you. And then we would compare the costs and the benefits of the service that they provide. Ultimately, just again, based on experience, ultimately we'll come back to Lincoln and 403B, Lincoln 403B or the Vanguard 403B as the top contenders on that list, simply because we've done this so many times that they keep coming back as the best value. Okay, so here's an example of a startup 403B plan. So 12 employees in a nonprofit with 2 employees earning $130,000 a year. I'm just trying to go through the entire, everything that we talked about, even if you don't have an organization where there's anyone earning over $130,000 a year and thus highly compensated. So 12 employees, 2 employees as highly compensated. They want to give an employer contribution, but they're concerned about their budget. They can afford a 3% match right now, but they don't know what's going to happen in the future. So how would we go around creating a plan? What's the discussion? Well, the first thing we would do is we would set up a discretionary matching contribution. So if they want to turn off the employer contribution because grants have dried up or donations have dried up, then they can do that automatically. The discretionary allows the flexibility to reduce or eliminate the contribution. In addition, we would add, after discussing with them, we would add a 1-year eligibility probationary waiting period. And we would make the employer contribution, the 3% match, 100% vested, simply because they want to reward their employees. They think that if they wait 1 year, then they know that they're a good employee and that they're going to stay for the long term, and they don't have to give them free money and only have them turn around and leave in 3 months. This is actually a recent retirement plan we did. Now, what we wanted to do was we wanted to keep the costs low. We wanted to remove the executive director and the CFO, the 2 highly compensated employees, from the plan. And now, because we don't have 2 employees earning $130,000 a year, now the plan is not subject to discrimination testing. Now, when I say remove the executive director and the CFO, I don't mean that they can't participate in the plan. I mean that they can't get employer contributions in the plan. They can still put away their money and save like anyone else. But they say, I'm not going to take the employer contribution in the plan. And that makes the plan not subject to discrimination testing. Instead, whatever match, that 3%, they're going to get in a separate account set up just for them, called the 457 Deferred Compensation Plan. The startup cost at Lincoln would have been $500 to set up the plan document. And then, as we said, there's $450 a year administration. And we avoided the extra $500 a year because we removed the highly compensated employees from the plan and set up that 457 deferred comp. Average fund expense is 1.5%. And for a startup plan with no money in it, because remember, the more money you have with a retirement vendor, the more you can negotiate, the more the fees go down because they have more assets. Here, you have no assets, so you're starting up a plan, like I'm assuming many of you in the audience share a similar story. So 1.5% is a very low cost for a plan with no assets. And this is one example of setting up a new retirement plan. And that's it. That's my presentation.
That was incredible. Thank you for, I think, making a somewhat daunting topic way more understandable and manageable. The one thing we haven't touched on is what are the tax benefits for the employees once they open the 403B. Could you talk about the tax deferred and things?
Absolutely. So the benefits of a retirement plan. Obviously, you're saving for retirement. So when you can structure a plan, a 403B or a 401k plan, with 2 sources of contributions, employee saving contribution. The first is the traditional pre-tax contribution, where the benefit to the employee is that they put away money. Whatever money they put into their 403B account, they avoid paying taxes on that amount of money in that calendar year. So if I earn $40,000 a year and I put away, or I shelter, as it's sometimes referred to, if I shelter $10,000 into my 403B plan, I only get taxed on $30,000 a year. My $10,000 is in the plan. It grows year after year based on the investments that I have. I don't pay taxes inside of my 403B, so it compounds a lot faster when you don't have to pay taxes. And then when I'm ready to retire and I take my money out, remember, I'm replacing my paycheck. I'm not taking it all out at once. When I take out money in retirement, I will pay ordinary income taxes at whatever level I'm at in retirement on the money that comes out of the 403B account. Everything else that remains in the 403B account is continuously stays tax deferred. So that's the first way and the first benefit that people can save in these retirement plans, to get a tax break. Very appealing to many people. For people who are in a lower tax bracket, you can also do a Roth 403B or a Roth 401k contribution. What you're doing in this is you're funding your retirement account with after-tax money. So you're not getting the tax break today, but your after-tax money goes into the retirement plan. It grows, again, tax-deferred. It compounds over time because you're not paying taxes along the way. And then when you're ready to take money out at retirement, so long as you've had the account open for 5 years, and so long as you take a distribution after the age of 59 and a half, all your earnings come out tax-free. So that's a Roth 401k or Roth 403b. So there are two different ways to set up a plan. You can offer both, and I see some people doing, half their contributions pre-tax, half their contributions Roth. And one of the things as an advisor that we do is that we sit down with the participants one-on-one with the employees, and we figure out what's the best way to save for them. If they're earning a very low income today, it may make sense to do the Roth and pay the taxes today because they're going to get tax savings in the future. We go through the different options for everyone.
And one last question. This time has gone so quickly, but emergency withdrawals. I know you can, as you're designing your plan, opt for employees to take out emergency withdrawals for various, and maybe emergency is not even the correct, but could you talk about that a little bit?
Sure. So you can design the plan with the ability to take loans out of your account. So that's one way you can access the money. And you don't have to have a reason to take the loan out. You can take a loan and tax-free money. And so long as you pay it back to your plan and don't default, then that's one way to access the plan. The second way, so the IRS, in order to take a distribution from a retirement plan, you have to have a distributable event. The reason you need a distributable event is because the IRS is giving you all these benefits, these tax benefits, and so there's a price that comes with getting these benefits. Distributable events include death and disability, obviously, termination of employment. So if you leave the organization, then your money becomes free and clear for you to move the money out and into your hand or to another retirement plan or to your own IRA. And then if you have a hardship, that's another way for you to access the money in your 403b or 401k plan if you're employed. Hardships include medical, housing, and so on. And you have to show proof that you actually have incurred that hardship. But that's a way for you to take the money out of the plan while you're still working. And you'll still pay taxes on it, I believe you still pay the 10% early withdrawal penalty if you take money out before the age 59 and a half. But those are traditionally the ways that you can access your money in your retirement plan.
Mm-hmm.
And of course, with the new COVID rules that came out, there are enhancements that will go away unless they extend it at the end of this year for additional liquidity from retirement plans due to COVID-19. But I think that's beyond the scope of this presentation.
Yeah. Wow. Well, and this is one resource that the IRS puts out that kind of describes some of the plans or the options for nonprofit retirement plans and setting them up, which I think now that you've heard Amir's presentation, I think you might be able to digest them. I know reading them beforehand, it was like my head was spinning. So thanks to Amir, really making it all much more understandable. We have 2 more upcoming webinars in our Business of Family-Run Organization series on Thursday, July 9th on insurance that nonprofits need, and on July 23rd, internal controls for small nonprofits. Also, very I really cannot thank Amir enough for his time today, sharing his expertise with us. He's done this pro bono for FREDLA, and we appreciate it so much, Amir. Thank you. And as he has noted, I know from experience he is available for anyone to pick up the phone or email him, and he's always available to guide you into the right place. Please sign up for the upcoming webinars, and also thanks to our tech people at the University of Maryland, who are always so incredible in what they do for FREDLA. So with that, we will, with one last thank you to everybody for sharing part of your day with us, sign off for now. Thank you so much. And thank you again, Amir. It was terrific.
Thank you, Jane. Take care, everyone. Bye-bye.
Bye now.